You spot a perfect demand level, enter the trade, and watch the price crash through your stop loss. Taking that trade blindly is like fighting a rushing river. You exhaust your capital trying to push against an unstoppable momentum. Trading these levels in isolation ignores the broader contextual puzzle of the market. The SLC framework, structure, level, and confirmation, addresses this by adding specific filters to every setup. Load up your charting platform and add a stochastic indicator so you're ready to build the system. This framework creates a repeatable process designed to filter out low-probability setups. Step 1 is structure. Switch your time frame up to a 1-hour or 4-hour chart to identify the direction of the latest price movement. This chart shows a market in an uptrend. You identify this by looking for progressive higher highs and higher lows as the price climbs. When the price forms a sequence of lower highs and lower lows, the structure is a downtrend. These structures dictate your rules of engagement. In an uptrend, you only look for long trades. In a downtrend, you only take short trades. If the price is chopping sideways and failing to break previous highs or lows, the market is ranging. Avoid taking any trades until a clear trend emerges. Identifying the structure helps align your capital with the dominant institutional momentum of the day. Step 2 is level. Drop your time frame down to a 1-minute or 5-minute execution chart to pinpoint entry zones that agree with the higher structure. A strong supply or demand zone is defined by a sudden, aggressive vertical surge in price. To map this, locate the massive vertical price spike, then draw your bounding box around the single initial candle that formed immediately before that jump. These aggressive moves indicate where heavy institutional orders were previously filled. When price returns to this rectangle, the remaining orders act as a springboard. Do not draw zones around small price bumps. These weak movements lack the institutional pressure needed to reject the price. Drawing these specific rectangles defines your battlefield. You ignore the noise and only engage when the price steps into your marked territory. Step 3 is confirmation. Don't enter a trade simply because the price touched your drawn rectangle. The stochastic pane measures market overextension. Focus on these boundary lines. As price enters your demand zone, the blue line must break outside the lower oversold boundary. Execute the trade when the blue line hooks upward, crossing back into the middle channel. This crossing motion proves buyers are actually stepping in. Without it, you risk buying into a market that is still crashing. Upon entry, place your stop loss just outside the edge of your drawn rectangle. Set your take-profit target at twice your initial risk, creating a 1-to-2 risk-to-reward ratio. This final confirmation acts as a safety valve, shielding you from catching a falling knife during sudden market drops. With all 3 steps aligned, the price respects the zone, bounces, and hits the take-profit target. This result is the byproduct of a disciplined process, swimming with the higher timeframe current, defining a specific battlefield, and waiting for confirmation. Maintaining this discipline during live market sessions is difficult, as stress often leads to rushed or emotional trades. To solve this, use the SLC execution blueprint, a 3-step checklist used before every execution. This blueprint provides the structure needed to transition from chaotic guessing